Hello and a warm welcome to the Open Treasury podcast, your go-to source for the latest news and analysis in corporate cash and treasury management. This show is brought to you by CTMfile.com and the Treasury News Network, where treasury professionals learn and share the information that matters most. I am your host, Pushpendra Mehta. Joining me today are Paul Galloway, Senior Director, Advisory Services at Strategic Treasurer, and Ben Poole, Writer at CTMfile. Paul and Ben, welcome to this edition of the Open Treasury podcast.
Thanks, Push.
Yeah, thanks for having us again.
Thank you so very much for taking the time to share your thoughts with us on topics that impact the world of cash and treasury management. Let's delve deeper and get your viewpoint on our topics for today, namely China's economic slowdown continues, Bank of Japan surprises financial markets by adjusting yield curve, the US Federal Reserve or Fed resumes rate hikes even as ECB follows Fed with rate increase, limited support for central bank digital currencies in global investment industry, and blockchain has the potential to save financial institutions US $10 billion by 2023. Our audience can read articles, interviews, and industry roundups by visiting CTMfile.com or by following the links in our show notes. Let's start today's discussion with our first story, which is about China's tepid post-COVID economic activity continuing in July, with manufacturing contracting again and the services sector weakening as Beijing promised modest measures of support to boost consumption. Concerns about the state of China's recovery have been mounting in recent weeks, with early indicators for July showing a weakening of momentum. Economists polled by Bloomberg project growth of 5.2% for 2023, lower than earlier forecast and more in line with the official target of around 5%. Paul, from a corporate treasury perspective, are you concerned that China's slowing economic growth will take a financial toll, particularly on multinational corporations with extensive exposure to the world's factory, China?
Well, Push, I don't see how slowdown doesn't impact the investment side of things related to exposure in China. You know, I think the slowdown has been in play for some time. At least I expect that we'll see some additional slowdown. Some of the things that we're starting to see around the world globally, India is starting to rise in terms of economic importance. That's a significant thing for India. It's been a push on their end for some time. So, you know, perhaps a rise or challenge to China, a neighbor. When we think about what's going on in the US in terms of manufacturing, we've seen a trend of onshoring or nearshoring with manufacturing. We haven't had that in the US in a long time. You know, this is something that is kind of new to us to be able to bring things back nearer towards. And I don't think we're the only ones that are doing that. And so seeing a contraction in China like this, it's not necessarily surprising. I think we've seen the trend heading this way. It could continue to go. You know, worries about exposure, I believe, are valid. 5.2%, you sit there and think, well, geez, you know, that's pretty good growth. It is. But in terms of what China historically has been doing, it's definitely a downtick.
Absolutely. And you've got to kind of think of the countries that really rely on China as well and the impact that it could potentially have on their economies. Some of the other countries in Asia, thinking about Australia as well. I mean, that's a country that has a lot of ties to China. And so it's not, it's that kind of interconnected nature and which countries that as a treasury you have to think about, you know, the knock-on effect it could have. Whereas if you look at the US, the recovery out of COVID, out of the high inflation, it seems to be kind of a lot more resilient in terms of what the economy is doing in the States. So, yeah, I think that's interesting. In the article, some of the purchasing managers index numbers were quoted, the PMI. And I thought that was interesting because they look on the surface very similar to lots of other countries' PMIs in that manufacturing is, lagging and services are kind of pulling the overall composite score up into growth. But a lot of countries are now seeing their services also sort of fall a little bit, which is in the China stat. But most countries, that's because it's really the impact of, particularly over in Europe and the UK, the long-term inflation hit really is prices that have suddenly, that finally the ice has broken and services is starting to come down as well. It's not that in China, of course, because inflation there is far, far, far lower. So, I think that just points to more structural problems in the economy and something for treasurers to pay close attention to.
Yeah, I think that's spot on, Ben. And good to point out, what's going on with exposure with other countries in the region. I think globally, there's lots of countries that do have exposure to China. It'll be interesting to see how they manage that exposure, in the coming months, maybe year. Are we going to see a trend where there's a downtick in exposure? There's certainly trade-offs to that. Is it temporary? Is it going towards the new norm for China that they have to face a reality that, you just can't continue to grow at 5, 6, 7, 8% a year. That's just not normal. They've been exposed to that for an extended period. Maybe it's time that they realize the honeymoon's over with, and now we got to get to what's going to be the new norm and how we manage with the new norm.
How do we manage with the new norm? That's a big conundrum for China. Moving forward from China to Japan, our next story in today's discussion revolves around Bank of Japan's yield curve control action surprising market participants. The Central Bank of Japan decided to keep the target for 10-year Japanese government bonds at 0% and the range at plus and minus 0.5%. But it is going to allow greater flexibility with overboots of the 0.5% threshold up to a level of 1%, where the Bank of Japan will conduct fixed rate purchase operations. The Bank of Japan has tweaked its bond yield control policy and will allow interest rates to rise more freely, action that market participants have interpreted as the start of a slow shift away from decades of massive monetary stimulus. Ben, you covered this story for CTMfile, and so I would be interested in knowing what you think about the tweaking of the bond yield control policy by the Bank of Japan, and if this is the start of a more significant monetary tightening or easing cycle.
That's a very good question, Push. It's certainly something that took the markets by surprise when it was announced. At the time, the Bank of Japan governor, Kazuo Ueda, apologies for the pronunciation, said that the Bank of Japan had underestimated inflation risk and that it was necessary to act preemptively to avoid, bigger monetary tightening steps later. But a lot of commentators have pointed out that this could be a currency-related play in terms of the yen being very weak against the US dollar, particularly. But also intervention being quite hard to justify as recent yen movement has been fairly moderate. So, that normalization of monetary policy that you talked about could well lead to a stronger yen against the dollar. Initially, like on the day it was announced, there was a rally of the yen, but it kind of fell back down again as trading continued. But I do think that overall, the trend of normalizing that monetary policy will lead to that path of a stronger yen. So that's something for treasurers particularly to look at and just kind of monitor for their FX exposures.
Yeah, when we think about the announcement by the BOJ, it was significant in the sense that here's a country for decades that have run at near or no inflation at all. It's a level that they've been at for an extended period. And so when you think about targeting yield curves going up or essentially doubling what the target potentially could be for them is a big deal. And I think it's definitely a play on the currency itself because, the reality is that other countries have been exposed to the inflation for, in recent years. And The dollar has been extremely strong, even though it's come down recent months. It's been extremely strong against other currencies. So, given that Japan is starting to see some level of inflation, which has not been normal for them, it's actually not a bad thing for Japan. They're a country that's aging. They're a country that's struggled with growth. And so for them, these are things that probably from an economic standpoint are really welcome because they haven't experienced it in such a long period. So I do think, Ben, you're on point with your comments around this. Definitely shocked the market on the front end, but it was short-lived because I think people realized, okay, you know what, they're making an adjustment because they really had to make an adjustment to get back to where they were before things started moving against them. So it's something that I think probably was warranted on the BOJ side. So I think the market reacted to it initially because they didn't expect it to happen. And then they realized, oh, I understand why they did this, and it calmed down.
Yeah, and it doesn't mean they're going to rush to raise interest rates, but it does give them kind of a little pool of data to analyze and see kind of what the findings are of making this move. If it does what they wanted it to, and it just, as I think we said earlier, kind of just frees them up to maybe have that potential to look at their rates, which is something quite different for them to be doing.
Yeah, definitely.
Moving from Japan, the world's third largest economy, to the world's largest economy, the US, our next story is about the US Federal Reserve, or Fed, hiking interest rates to highest level in more than 22 years. The Fed has raised its funds rate by a quarter percentage point to a target range of 5.25% to 5.5%. The midpoint of that target range would be the highest level for the benchmark rate since early 2001. The European Central Bank also met market expectations by raising its benchmark rate by a quarter point to 3.75%. The ECB said that inflation continues to decline but is still expected to remain too high for too long. Paul, the latest round of rate hikes effectively increases borrowing costs for corporates. As the ability to borrow may become more challenging for businesses and cost of capital increases, ensuring adequate liquidity will become critical. In the light of the rate hikes, do you think Treasury teams should in particular focus on improving days sales outstandings and days payable outstanding to provide more efficient access to working capital? Or would you recommend some other measure for prudent working capital and liquidity management?
Yeah, Push, that's a great question. I mean, obviously the Fed has raised rates quite a bit over the last 12 months. We've seen significant increase. We are nearing or at the end of rate hikes. We'll see. There could be another one in there potentially. It just depends on what the economic data is saying. We are having some dispersion in terms of what the Fed governor's views are. You're starting to see some different views in terms of what they're supposed to, what they should be doing. This is signs of we're probably getting to the end. And so what we've talked about before, Push, around this topic is that if treasurers haven't already put in place the various levers that they need for access to capital and liquidity, it's obviously going to cost them more. And so you look at these rates, 5.25 to 5.50, and you think about what rates might be based on their credit ratings with spread. We're getting up to levels that, they got to start asking, how much do we go for? How much do we really need? Do we need additional contingent liquidity in place? Are we utilizing other levers to pull, whether it's around payables or receivables, whether it's around contingent capital facilities, whether it's around becoming just more liquid in the cash that they have on hand, or perhaps not investing capital in projects that they normally would have, or doing less of that Maybe they're looking at how they return capital to investors. But at a broader sense, when cost of capital starts rising, treasurers are as a function of their job, their role, they got to look at the overall capital management landscape. Return on, return of capital. What does that look like? What should it be? What should the targets be? Is our weighted average cost of capital at the right level? Given that rates are rising, do we have the right facilities in place to ensure that as rates rise, we aren't having to incur additional costs? They're less floating, more fixed. Or they, if they are engaging in those floating instruments, how are they hedging themselves? What are they doing to protect the amount of cost that is associated with access to capital? And do they even have the right level? Do they understand their forecast? Forecasting your FP&A teams become more important, working in conjunction with treasurers to understand what they need, and working those relationships, managing the relationships with your banks is super important. Share of wallet, share of business. These are things that are going to be important for a treasurer.
Yeah, it's also interesting to look at, where the different central banks are in their hiking cycle, and just something for treasurers to consider, kind of as well as what they're doing themselves inside their business. Obviously, we knew that this Fed rate hike was coming. They telegraphed it basically from the previous meeting. Like, even though it was a pause at the previous meeting, everyone said, this is a hawkish pause. This is part of our continued, basically just like lifting the foot off the gas pedal, but not hitting the brake, essentially. So, and the ECB rise also was known about. So I think, the markets were pretty sure that was going to happen. It's kind of interesting that the Fed is sort of leading the way here. Like, I think it feels like they're very close to the end of the hiking cycle as it is. Like, they're sort of, maybe, we get another pause and then another 25 basis points from them, basically taking it meeting by meeting now, which is something that the ECB said in July as well. So kind of following what the Fed has been doing. So both of them are seeming to sort of feel pretty good about where things are, particularly in the US, in terms of the fact that, inflation is, a lot lower than where it was. One thing I would say is that obviously we're not going to be getting rate cuts anytime soon. I think what both the Fed and the ECB have signaled is that if the data is really positive, then there's room for a pause. But if it's negative, then we will hike again. That, there's not, if the data is really good, then, we can just, maybe take 25, 50 basis points off. So that I don't think that'll be happening this year, to be honest. So that's just something for treasurers to monitor. But yeah, it seems like maybe a soft landing, particularly in the States, is more possible than perhaps we thought a few months ago.
Yeah, it's definitely more possible than what I thought several months ago. It still remains to be seen. We are still in the midst of a very strong labor market here in the U.S., even with rates being where they're at. And with overall inflation in various locations where lots of jobs exist, we haven't seen a slowdown in spending, which is, or I should say, a significant slowdown in spending. During this period, there was slowdown, but people, myself included, I think are back in the spending mode. They're starting to engage in projects that they hadn't been engaging in. I think people became a little more liquid and flush with cash. And so they had there's this level of pent-up demand, I feel, that's been keeping us away from going into a recession. We easily could have gone into a recession. Economic data was suggesting that we may have already been in a recession. I thought for a period we were in one. I had, maybe we are going to have a soft landing. It's been an interesting ride. It seems like when we had these events, if you think of 08, 09, and you come to COVID and what's gone on here, these events don't behave the same. And what we've known in the past may not be an exact indicator of what's going to be in the future. So it will be interesting to see, are we going to ride out of this with a soft landing and be able to keep on going? That would be fantastic. I don't think anybody's going to complain about that.
No. Well, one thing we do know about kind of the economic fallout after COVID is expect the unexpected. So just because something's pointing in one direction, don't expect it to be going exactly that way, the following month.
Stay flexible indeed. Both of you made very informative points, and I'm sure our target audience would have paid attention to what you just said and would keep that in mind. We are living in uncertain times, but I agree there should be more of a soft landing. Let's move on to the next story in today's conversation, which is about the limited support for central bank digital currencies or CBDCs in the global investment industry. A comprehensive survey of the global investment industry's attitude towards central bank digital currencies or CBDCs has found both limited support and a lack of understanding of how a digital dollar, euro, yen, or pound would work. The survey carried out by the CFA Institute found that only 42% of more than 4,150 respondents who took part believed that CBDCs should be launched. Around 130 countries representing 98% of the global economy are exploring CBDCs. Even for a sophisticated and financially literate cohort like our members, there is very little understanding of what CBDCs are. The CFA Institute's Olivier Fines told Reuters. There was also a general feeling of skepticism about their possible benefits, especially in developed economies where people can already pay for things instantly online or using mobile phones, he said. Only 37% of respondents from developed markets said they favored a CBDC versus 61% from emerging markets, while 31% of respondents in the US supported the creation of a digital dollar, followed by 38% in Canada, 45% in the European Union, and 46% in the UK. In China, in contrast, where the People's Bank of China is currently running the world's biggest CBDC pilot project, the support rate was 70%, while in India, which hopes to launch a digital rupee next year, it was 66%. Ben, I have two questions for you. Were you surprised by the findings of the CFA Institute survey in terms of the limited support and a lack of understanding in the investment industry of how CBDCs would work? And do you think there is a clear divide between the world's leading economies on CBDCs, with China and India betting on CBDCs in a big way, while the US and the UK are still in the research and exploratory stage?
Thanks, Push. Two sizable questions there. I think with the report, and you touched on this a little bit in your coverage of the story, I suppose we are in a little bit of a financial services bubble in our line of work. And this is quite a good reminder that a lot of what we talk about that, is related to Treasury and finance might not exactly line up with the person on the street's priorities. So I think you could look at this as maybe a wake-up call for central banks. If they're, pursuing this policy, they need to focus on communication to people in terms of why they're spending so much time, effort, and money on exploring these digital currencies. Is there a use case? We hear a lot about the use cases for CBDCs, but I think we have maybe one or two phases to go through in the evolving payments world to actually get to a point where CBDCs are sort of widespread and can be used, cross-border, not just in country. That's a big issue to think about. So, I think that's just a wake-up call for central banks. And in terms of the split in how different countries are approaching CBDCs, I think when you look at the US, you've got a globally important currency there. So you've got to be very careful with how you look at sort of replicating that in a digital form and the meaning of that, because it's used in so many different markets, in every market around the world, basically. So there's a lot more riding on some of the more established currencies, I would say. Everybody is investigating this, but I think you can see by the countries that have gone live already with CBDCs that it's not the big economies that are going first. So that's, I think, just something I think a bit of caution is probably quite wise particularly on the part of the US.
I believe that CBDCs are going to happen. It's just a matter of when. It's not, are they going to? They will. I think it's going to take time. I think there's a lot more investigating that's going to occur within the US and probably other countries before we see them hit some of the more prevalent currencies that are trading out in the market. There's some, just internally here in the US, there's some negative connotation with the idea of going to a digital currency. People view it as, not a good thing. Well, how is the central bank going to be able to sell the idea of this to the people? Because at some level, they're going to have to do that. So there's going to be some education. There's going to be research. There's going to be other countries here are going to, take the step first. So you see, China is embracing it. Well, it may take other countries to embrace it, adopt it, and utilize it before it happens in the US. So I can think about an example of chip cards. So I used to travel over to Asia to do a lot of operational audits for a company I was working for. Yeah, and in Asia, you had to have cards that had chips in them. You couldn't be over there without one, otherwise it wouldn't work. They all use chips. In the US, that wasn't even a thing at the time. It was getting a chip card was like, oh, no, nobody has that. Well, now everybody has it. The U.S. is just slow to adopt some of these technologies. It's just a fact, and I think about the CFA Institute being involved in a survey like this. I'm a CFA charter holder. I'm glad to see that the CFA Institute is taking interest in this topic. I think it's something that the Institute can help influence, as we do with a lot of things that from an economic standpoint, investment or financial banking, otherwise, that the Institute has influence on lawmakers, decision makers. I think this is a really good thing for the central bank to have an institution like the CFA Institute there at the table taking interest in this. So that tells me that credibility of CBDCs, the relevance of it is starting to rise to the top. People are starting to listen. They're starting to pay attention. And, we need to, because it's going to happen someday.
Absolutely. Yeah. One mischievous final point from me. I was wondering what might come first, the introduction of the digital dollar or the phasing out of the paper check in the US, because they're two very different ends of the spectrum of payments.
Yeah, so early on in my career, I worked for, it was Norwest Banks. We bought Wells Fargo, became Wells Fargo. But at the time I was working with them, I started working, it was Norwest Banks. And I managed a teller line at a local bank location here in Des Moines, Iowa. We would have, it never failed, whenever the Social Security checks came out, all the retired people came in with their Social Security checks to deposit them. And I'm sitting there going, man, I think they just like to have that piece of paper in the hand to be able to, say, hey, here it is. I got it in my hand, and, deliver it to the bank, and they know it's there. I can't stand checks. And there's still tons of people out there that still like checks. Me, I don't need a check. Anything that I can do electronically, I'm good with. But there's a lot of people that aren't. They want a piece of paper in their hand still. And so it's like death by 1,000 paper cuts for checks. It's just not going away anytime soon. Eventually, I think it will disappear. It will go away. But it's just taking a lot longer than what I think people anticipate.
Moving forward from digital currencies and digital payments into another realm, which is blockchain and its effect on cross-border payments, our next topic is about how blockchain has the potential to save financial institutions approximately US $10 billion in cross-border payment costs by the year 2030, claims a newly released report from crypto solutions developer Ripple. Among the 300 financial professionals surveyed across 45 countries, results show that global payments leaders are dissatisfied with legacy rails for cross-border payments, commented Ripple, and 97% said that they believe that blockchain will play a crucial role in faster payment systems within the next 3 years. Paul, do you think from a corporate treasury viewpoint, blockchain technology has the potential to significantly change the way cross-border payments are made?
Yeah, Push, I absolutely do think blockchain has a part to play in that. We're seeing evidence of blockchain become a more significant part of payments just writ large. So from a cross-border standpoint, it makes sense the way the technology works and what it's able to do. There's a lot of different players out there that are involved in this. And I think eventually we're going to see some commonality in terms of how that plays out. And so I think it's getting a better understanding by some financial institutions in terms of, how does blockchain actually function? I think more and more, the tier one banks have already accepted, its use and how it works. They've got APIs. They understand how blockchain works. I think, from a standpoint of the larger institutions, they're taking the lead. So with the adoption rate by the larger financial institutions, I think we'll see that it will trickle down across smaller financial institutions and perhaps smaller players in the market. It's got to start somewhere, and I think that's where we're starting to see evidence that blockchain does and will play a bigger part in cross-border payments.
Yeah, reading this, my first thought was there's a little bit of the blockchain company says blockchain is the answer to the headline. But like you say, Paul, there is truth to this when it comes to cross-border payments, which can be so slow and expensive, and that there's such a kind of can be a drag on treasurers as they're going about their business, trying to figure out, where their cash is, what's gone out, what's coming in. You get the sort of multiple intermediaries and different regulatory requirements in different countries. So blockchain could easily sort of change that by dramatically reducing the amount of intermediaries involved, potentially just payment passing between the sender and the receiver directly. So, that's obviously hugely important for the people that are making the payments, but also for the banks, in terms of the investments that obviously they're charging for every time the payment goes between them to someone else. But, having to maintain that infrastructure as well is a cost. So, I think it's another kind of exciting development to look forward to. It's something that's not happening today on a large scale, but the innovation is very interesting. So it's certainly an area to keep an eye on for treasurers. Again, it's kind of one of those sort of secondary topics, I think, for treasurers, but it's still in the bag that should be looked at.
Yeah, it's definitely talked about. When you think about the costs associated with this technology, they're significantly lower. It's not just by a little bit, it's by a lot. Once people realize, one, that it functions and works, that the transfer of payments is secure and fast, they'll realize, geez, what's the downside to doing this? They're going to realize this is going to be a good thing. Obviously, infrastructure has to be there. There has to be an adoption rate that happens. And like with anything that's new, it varies in terms of how things are adopted. Sometimes some things are just adopted very quickly. Sometimes it takes a longer period of time. I do believe the evidence is showing that this technology is going to play a part.
Interesting that I could get your perspective on two new emerging technologies, one being central bank digital currencies, the other being blockchain. And I'm sure the audience will benefit from your informative insights. Finally, Paul and Ben, what is your choice for the biggest or most important story of the past week and why? If I may ask Ben, for you to go first, please.
Yeah, sure. I was thinking about this. I had a few options, but I think I will go with the just the rate rise news in the US and from the ECB, and just like we're saying about potentially approaching, not being there, but approaching the end of this particular hiking cycle. So I think that's kind of the one that sort of created the most waves for me this week, I think.
Yeah, I could easily go with former President Trump being indicted on more charges, but I'm going to sway away from that. And the Bloomberg headline that popped up this morning when I signed on was Fitch's downgrade of U.S. credit. I thought that was something that was not, well, they did kind of telegraph the potential for the downgrade, and they went ahead and they did it. So I don't know that we'll see, S&P and Moody's follow, but this is definitely, something that's I think people should take notice of this. It's not necessarily insignificant. At the same time, it's not necessarily significant either, but it is a telling sign. I think people need to pay attention to what's going on out there with the rating agencies. And we in the US, I think we just got to take a look at our fiscal responsibility and determine, are we doing the right thing for our people here? Can't ignore it.
Can't ignore. Thank you so much, Paul and Ben, for your informative analysis and your discerning insights. We would also like to thank our CTMfile audience for joining us on this edition of Open Treasury. Please subscribe and look in the show notes for the article links. Thank you and have a great week. This podcast is provided for information purposes only, and statements made by CTMfile or guests on this podcast are not intended as legal, business, or consulting advice. For more information, visit ctmfile.com.